Hi, thanks for coming back to Real Estate Insiders. We are joined by Tanya Rose. She's with the elite lending team at Fembi Mortgage, and she's also an expert in something called HomePath. And you're going to learn from the expert exactly what that is and how you might want to get involved in that at one level or another. So thanks for joining us today, Tanya.
Thanks for having me.
Tell us a little bit about how long you've been doing this, and we'll get right into HomePath.
Well, I've been a mortgage loan officer for 18 years, and love every minute of it.
And HomePath is obviously something relatively new, I would say, in the last 5, 6, 7 years. So let's give a brief overview just exactly what it is.
A HomePath loan is a loan that was a property that was foreclosed on by Fannie Mae. And so then Fannie Mae takes it over and they put it on the market as a HomePath loan.
Okay, so I mean, we all know there's been a big, we all know there's been a big influx of foreclosed properties that lenders seem to be holding on to, or Fannie Mae is holding on to, and they're releasing them into the market.
Correct.
So we're talking specifically about homes where loans were serviced by Fannie Mae, they foreclosed, now they own the property, right? So why is there a HomePath program? What is it for?
Well, you know, Fannie Mae does a lot to try and keep people in their homes. Unfortunately, sometimes they can't. They foreclose on them, or it could be a deed in lieu too, where the property owner signs it over. They want to quickly turn it around and put it back on the market. So they created the HomePath program so that they could quickly get the property back on the market and into sold. So, you know, getting the areas back up to par.
So their efforts are really geared towards maybe making the property, not maybe, certainly, making the property more marketable.
Correct.
Would they do any physical improvements to the property?
They do. They do some. I mean, some might have some improvements. They might paint a wall. They might put some new carpet in. If the people maybe sold the appliances before they left,
right,
they'll put new appliances in, light fixtures that are missing. You know, they do sometimes do a lot of work on the property to make it marketable.
Well, and it sounds to me like most of the improvements you're talking about are cosmetic improvements. It's something that's, you know, at first sight you'd say, oh, this is beautiful. You still have the opportunity to do an inspection on those properties?
Absolutely. You know, you have your standard real estate contract is written, and you tag on there that you're going to do the HomePath program, and you choose what inspection period you want. Standard is 10 days, of course.
Right.
But however your realtor writes it up.
So all the other, roof, plumbing, electrical things you want to know that are sound, don't assume because it's got a new coat of paint on it that everything else is fine. You should still do your due diligence and have your inspections done. Although it's not going to be like a house I would expect where a bank foreclosed and the people kicked in every door on the way out and took the plumbing with them, right?
Right. You know, Fannie Mae comes in and tries to fix that stuff. And I recently saw one where the property had 3 bedrooms. 2 they repaired, 1 they left for the new owners.
Right.
So, sometimes it's good for a handyman special as well.
Right. Okay, so there's opportunities there, and again, it's all about making the property more marketable. At least you'd have less improvements to do normally on a HomePath than one that wasn't HomePath.
Perhaps a short sale that's been sitting for 10 months.
Yeah, that's just been vacant, so at least it's cleaned up, I would expect.
Right.
So that's from the marketing standpoint, but now you were explaining about how they use these HomePath homes to attract buyers with special financing. I think that's the strongest aspect of HomePath.
Absolutely. You know, HomePath allows for just a 3% down payment, and they don't have any mortgage insurance. Typically, when you have a small down payment, you have a high mortgage insurance. It really heats up your payment. With the Fannie Mae program, they don't have to have that mortgage insurance, so their payment actually becomes a much less. Fannie Mae's already taken the risk. They already own the loan, so they insure that loan when it comes back through.
So Fannie Mae is insuring the loan itself. So you're going to pay the difference. I would expect the interest rate's going to be a little higher.
Correct.
Because it's what they call self-insured, but when you look at the monthly payment,
it's always going to be lower with just a little bit higher interest rate than it would be with the mortgage insurance you'd see on a conventional or an FHA loan.
Yeah, and I think people need to be aware from a tax standpoint. Right now, you can still write off mortgage insurance.
Correct.
But that's just been over the last couple of years, where the idea of being writing off the interest is a lot more long-standing, and you never know with how tax code can change.
Absolutely.
But right now, you'd be writing off all that interest that you're paying because the loan is self-insured. Any other advantages to the buyer? You said low money down, no mortgage insurance. How about qualifying?
Well, they do allow for, I mean, we have to get a DU approve eligible.
So it's got to go through an automated approval
It has to go
system.
through an automated approval system. But here's, let's go back a little bit to the mortgage insurance. The credit requirements is a little bit lower on the credit score. So if you were having a conventional loan, you would have a very high mortgage insurance with a low credit score. So that
Right.
low credit score makes it more attractive for a buyer.
But would it be, since we're talking about minimal down payment loans, is it easier to qualify for the home path loan with, let's say, 3% down than it would be a regular conventional loan with 5% down where you need to get mortgage insurance?
Yes, you're going to qualify for more because your payment's going to be less.
How about credit scores and things like that?
Well, credit score requirements are pretty low, 660, which is about the same as a conventional loan, but it seems that when you choose that home path program, you get a little bit more risk, a little bit higher on the ratio that you can go.
Okay, and we know it's totally separate, it's not FHA, it's a totally separate program. But you had mentioned something to me earlier that reminded me of FHA, and that's a situation where you can bring in a non-occupant co-borrower. So explain how that works.
Okay, so if you have maybe a child that's going to school somewhere, college, and dorms are full, and there's some properties, you find a home path property, it can be, you could purchase it, and your child would be the owner occupant, and you could be the non-owner occupant. So they wouldn't necessarily need to be a job. They're just a school age. They're going to school. They don't have an income, but the parent can use their income to help them qualify for the property.
Right, and I know this is a really popular subject now because home prices are going up, but I think they're still a good buy, and interest rates are still relatively low. So I think as a parent, you think, geez, if I could get my kids into a home buying situation now, it may be the opportunity of a lifetime.
Absolutely.
There may be so much upside to it. So you're saying that if the child doesn't work, doesn't have an income to qualify, how do you put that whole picture together with a non-occupant co-borrower? You've got the child, maybe has a part-time job or is in school, but we want to I'm a parent and I want to be able to buy a home in the child's name so they have their foot in the door of home ownership.
Right.
How do they qualify?
They need to qualify based on the parent's income, but they do need to have a credit score. So, so the child needs to have a credit score, credit for at least a year on a year history.
So if they don't, the best advice that I think I could give them would be to get with someone like you early, because if you don't have a credit score, it's not hard to get one.
No.
And then you can put this whole thing together before prices and interest rates start going up to where they're going to qualify for a lot less home. And we all think that as those go up, it means you're taking away from the upside if I was able to buy now.
Sure.
So I guess for that home buyer, I'm sorry, go ahead.
No, I just wanted to mention one other thing we were talking about. I wanted to go into the properties that are eligible because, one of the things is if you're buying something for your child, you might, that might be a townhouse or something doesn't require a lot of maintenance. So one thing is condos are also, if a condo's on there, you can do the 97% financing without getting the condo approval and all that.
And everyone's talking about how the condo market is really starting to take off now because there's financing available again. So what a great time to be able to get your child in ground floor in a condo and then just watch the values go up. So if some of the other benefits I know that you mentioned before we talk about how to find these properties, there's no appraisal done.
There's no appraisal. Because,
they already own the property and they're coming up with the price and they're going to lend against that value. We've got no mortgage insurance.
Correct.
Smaller down payment, easier to qualify. So how would I go about finding these properties? If I know, geez, that's me.
Yeah.
Low down payment, I have to qualify. How do you find them?
Well, Fannie Mae has a website. It's homepath.com. and you can go on there and check out properties. However, I wouldn't just go on there, or some of them have an online bid that you can make. I wouldn't suggest doing that yourself. I would find a qualified realtor, because you always want somebody to represent you when you're purchasing a home in a transaction.
You mean they would bid on the properties right online?
Correct.
I haven't tried that, but as soon as you mention going through this type of transaction, I mean, we've covered a lot of intricacies of something.
Absolutely.
I don't think I would want to step in those waters without, not only without a realtor, but a realtor that's familiar with HomePath, right?
Yeah.
So I would expect, and I know for a fact that there's realtors that specialize in dealing exactly with those properties. Do you see that there's more and more of them available now, or is it like a steady stream that they seem to be letting out?
There's more and more coming available. I would say probably 2 years ago, you would find them. It kind of was almost like a lower end property we thought they were coming into, but it's now we're seeing them in all neighborhoods. There's one in my neighborhood right now, and I live in a pretty nice neighborhood, I think. So,
I'd be your neighbor.
so yeah, there's a lot more, from price ranges anywhere from 50,000 to 500,000 I've seen on the HomePath.
Yeah, and I know that's a whole new market of HomePath in that price range. So a number of reasons people should reach out to you. Number one, look at the financing process early in case you don't have a credit score, or there's things that need to be put into place as quickly as possible before rates and prices go up.
Correct.
But I know you've also got a network of agents that deal with HomePath properties. So if someone's interested in being hooked up with one of those agents, rather than hitting the phone book, you would be the person to call.
Absolutely.
So tell everybody how they can reach you if that's how they want to move forward.
All right. You can call me at 561-398-1003 or visit my website. It's www.loansbytanya.com, or of course email me at tanya@loansbytanya.com.
Thanks so much for coming in today. I know we're going to have a lot of requests for information on HomePath now that people are more informed about it. Thanks a lot, Tanya.